So let's talk about one of the biggest and honestly, one of the quietest transformations in the world of finance since the 2008 crisis. We're looking at a huge shift in how businesses get the money they need to grow, to innovate, to just keep the lights on. It's a fascinating story about rules, empty space, and a whole new kind of lender stepping up to the plate.
Okay, so let's just start with the main question, right? For decades, if your company needed a big loan, the answer was obvious. You went to a bank. Simple. But what happens when the banks start to say no more often? When those traditional wells of capital start running dry for a whole chunk of the market? Who fills that void? That's exactly what we're going to unpack.
To really get what's going on, we've got to rewind the clock. And our story starts where so many modern financial stories do, right in the middle of the 2008 global financial crisis. That one event is what created what we now call the Great Lending Vacuum. And here's how it happened. It was a pretty clear chain of events. After the 2008 meltdown, regulators, for obvious reasons, were determined to stop that from ever happening again. So they brought in these sweeping new rules. You have probably heard of them, the Dodd-Frank Act in the US, Basel III globally. Now, here's the crucial part. These rules made banks hold way more cash in reserve, especially for loans that seemed a little risky. All of a sudden, for a traditional bank, lending to a medium-sized company or funding a private equity deal just wasn't as profitable. So what did they do? They backed away. And that left this huge gap in the market. As you know, a vacuum in nature or in economics never stays empty for long. So as the banks pulled back, a new kind of player saw this massive opportunity and just jumped right in. And this, my friends, is where private credit makes its grand entrance. So what in the world is private credit anyway? Well, its main tool is something called direct lending. Think of these as private funds, not massive public banks. And that's their superpower. Because they aren't playing by the same strict rulebook, they can be way more flexible. They can create custom, tailored loan packages for companies. And they can often do it faster and more creatively than a big bank ever could. So really, we've watched a three-act play unfold. Act 1, the old world, totally dominated by banks. Act 2, the regulatory shakeup that put them in a bind. And Act 3, the new era, where private credit swoops in to fill that critical financing gap. A total market shift. Now, this whole transformation didn't happen everywhere all at once. The market that really grabbed this new model and ran with it first and fastest was the United States. Because those regulatory changes hit so fast and hard in the US after 2008, the private credit market there just exploded. Fast forward to today, and it is by far the biggest and most developed on the planet. I mean, a huge percentage of all major corporate deals, we're talking leveraged buyouts, big acquisitions, they're not being funded by a group of banks anymore. They're funded by these private credit firms. It's a game changer. Meanwhile, across the Atlantic, Europe was on a similar path, but its journey had its own unique flavor. You see, the continent's system was more traditional, more focused on banks, and the legal landscape was more fragmented. That meant things got off to a bit of a slower start.
But once it got going, especially after Europe had its own banking crisis around 2012, the market started growing like crazy, even faster than the US in recent years. And it got incredibly sophisticated. Lenders started offering this whole menu of complex products, stuff like unitranche loans, which kind of blend different types of debt into one simple package, or mezzanine financing, which is this hybrid between a loan and owning a piece of the company. The point is, these weren't just simple loans. They were highly customized financial tools built for all kinds of different borrowers, especially in that really crucial mid-market space.
This slide really lays it all out. Side by side, you can see the different roads each market took. In the US, the spark was those post-2008 regulations. In Europe, it was their own banking crisis a few years later. The US was first out of the gate and is now a mature, established market. Europe, on the other hand, had a slower start but has been growing much faster recently. And look at the focus. The US is huge for those big corporate buyouts, while in Europe, private credit absolutely owns the mid-market, that space the banks pretty much walked away from. So let's put all the pieces together. What does this all mean? Well, this isn't just some temporary trend or a blip on the radar. What we're looking at is a permanent reorganization of how corporate lending works. A whole new financial ecosystem has been born. And I mean, just look at the scale of this change. It's staggering. Before 2008, private credit was this tiny niche player, a boutique industry, really. Today, it's a dominant heavyweight champion in the market. And this right here, this is the main takeaway. We've shifted from a centralized model where just a handful of giant, heavily regulated banks controlled the flow of money to a much more decentralized system based on all these different funds.
This has created this incredibly robust new world for lending that basically operates outside of the public markets and traditional banking.
And that leaves us with one final and kind of thorny question to chew on. This new system, no doubt, it filled a void. It fueled growth and opportunity for thousands of companies. But a key feature of this whole model is that these funds operate with way less regulatory oversight than the banks they replaced. So the big question for the future is, what happens when the new watchdogs aren't really being watched? Something to think about.